Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Well, it is that time of year, folks, where spring's around the corner. Your portfolio's possibly rebounded a little bit. Maybe you're still blue in 22. That's what we're going to be talking about here on Money on Tap today. My name is Seth Cressman, joined here once again with Ben Brayshaw and Dan Mickelin. How are you guys doing today?
I'm doing great. Seth. How you doing, Dan?
I'm doing really well. Excited about the show, how to look forward for 23.
How are you feeling? Are you feeling blue about 22, Dan?
I was feeling blue about 22, that's for sure. It was a rough year, the 401k. Yeah, feeling better so far this year, and I think we got some good advice for everybody as to how to get positioned to make the best out of volatile times and, feel a lot better about where we are and when 24 starts.
There was just so many things that came through. I mean, it was, for me, it was a healthy break. The markets took their foot off the gas. I know it doesn't feel good to see what happened in the marketplace, and I don't blame anybody for looking at their 401k thinking, what in the world? How do I get out of this? I also think back of how many shows we've done this last year, really talking about some opportunity. Half the game, folks, here is we're talking about having, positive mental attitude, being a successful investor, not allowing fear to dictate your outcomes. So much of what we do in this space is really focused in all of these areas with our clients. If you don't know who we are, by the way, we're financial planners. If you're like dropping into Money on Tap, like, what in the world? What are these guys going to talk about today? Who are they? That's what we do. We're financial planners with Brayshaw Financial Group, and we have a lot of conversations with our clients. We bring that to the table with you. We're talking about three-dimensional investing, taking a look at all sides of the issues. How do we put the pieces together? Because guess what? You're not just a number, right? You have a lot of story behind where you're at right now, and you have some goals, you have some things you want to accomplish with your finances. And so we pull all that together. We talk a lot about your next step and being successful in investing. And that's what we're going to be doing on this show today. And Ben, I feel like I just ran you over with the train there, buddy, and not to let that first article in Money in the News out of the hat quite yet. But did you have something else to chime in on that?
No, I think you're right on. I think three-dimensional investing is really the focus that people are missing in the financial world. The insurance, brokerage, and fee-based planning. Usually when you're working with somebody, it's one of those three legs of the stool, and you really don't get the full gravity of what you could be doing in a in that three-dimensional space and really trying to make things tune together inside your portfolio and what you need to accomplish. And I think we talked about, being the best you can be in 23 and being blue in 22. I mean, we're talking about these, that was an older show that we did. And we're talking about these things because there's always opportunity out there, and trying to find that space. That's what we are. We're always discovering new opportunity. But if you only work in one of those legs of the stool, the field is a lot smaller to do any discovery in. And I think that's where, when you work with three-dimensional investing perspectives, it just gives you a little bit of a leg up.
Yeah, and and to feel blue about 22, I mean, it was kind of saying that part in jest. Although I saw losses in personal accounts that nobody ever wants to take a look at, but I do believe in the one thing that we've pounded home in the show a number of times, and it's not timing the market; it's time in the market, right? Mm-hmm. So regardless of what happened, I'm definitely not hitting eject and bailing out of the market. It is an opportunity to kind of reposition yourself, maybe look at some different allocations. But to stay invested is the way to be successful over time, for sure.
Well, yeah, and the other thing is there's a zillion different investments out there when you're buying independently through an IRA or a non-qualified brokerage account, like your own investment account. But when you're in a 401k, you're basically traveling on a bus across country. It's like it doesn't have roll-up windows. You're kind of in the market, and it's a different kind of animal. And I think taking the personalized approach and how we work with people in a very personal scenario. Like, we don't do retirement plans. Like, that's not the focus of our practice. We're not taking on companies and saying, we'll run your 401k. Not that we can't, not that we couldn't do that, but that's not the game that we play the best in. We play a boutique firm where we really help individuals, small business owners, people to really amplify their hard work into something way more than they could have ever hopefully dreamed it to be.
Wow. Thank you. That says it for me. You are listening to Money on Tap. And now it is time for Money in the News.
And
first up in Money in the News today comes to us from the Tampa Free Press. Corporate bonds may explain media coverage of the toxic Ohio train derailment disaster. Long title, but I know it's a story that all of us have seen, to probably varying degrees of shock and awe and looking at some of the images. But, obviously back on the 3rd, we had that major train derailment in East Palestine, Ohio, that looked really absolutely devastating, seeing the smoke billowing out of that. And, there just had to be a lot of concern for anybody anywhere close to that as to what exactly was going on and what kind of chemicals are about to be raining down and, what impact that's had to the whole ecosystem there. I know it certainly looked concerning here. And, there was some very hazardous stuff that the government institutions responsible determined that the best way to deal with it was essentially to burn it on site, which seems like a ridiculous idea. I don't know. I'm not quite sure what they were dealing with there, but you would think that is not the way to go. But what's
the evidence, Dan, that's what they were dealing with.
Burning the evidence. And this article kind of points to that and who might be behind some of it. But, what's interesting to find out as people have taken a step back from the immediate reaction to this and kind of trying to understand what's happening in this disaster is that, there is common ownership of that rail company in a lot of our major media outlets. And that comes in the form of BlackRock and Vanguard, who own significant portions in each entity. So they're the top 2 shareholders of Norfolk Southern, which is the train company.
They own $4.3 billion and $2.6 billion, respectively. Vanguard owns $15.1 billion of ABC and NBC and another $1.3 billion of its parent company, CBS. I mean, this is everything we're always talking about. I mean, it's just like there's just so many.
I know this would kind of tickle the conspiracy, notion here.
There's no conspiracy.
Yeah, there's no conspiracy.
This one's pretty obvious. Yeah.
I like that T-shirt that says, I ran out of conspiracies because they were all proved true.
This one, I got to say, falls right into that,
There's no doubt about it. If you want to follow the money there, Ben, you were talking about the Vanguard ownership. BlackRock owns $8.3 billion worth of ABC, $8.1 billion worth of NBC, and $640 million of Paramount. And when they were taking a look at how much airtime that they have been given to this story, it was like 30 minutes. The big 3 networks spent just 30 minutes combined covering the derailment.
When it actually gets down to the news, I mean, they had images from above looking down at this cloud, and it was absolutely horrific. And I just saw the mayor and the fire chief got together and they're drinking the tap water, to reassure everybody that this is safe. Meantime, there's livestock dropping dead for miles, and it just looks horrendous. It really does.
This is the part that I feel like we need to have a little responsibility for all of us, right? And just recognize if this is where you're getting your information, you are being fed by big money out there. It's huge. It's big money. And I don't know, man. I'm not trying to say Vanguard's bad or BlackRock's bad. I'm just saying you got to consider, folks. They have an interest, and they're going to go ahead and put the things out there as they want them as much as possible. And it was very interesting to me to see in the article, had this been under the Trump presidency, how much would it have dominated the news? And that's a factor, folks.
It's interesting, too. I was reading an article, it's not on here, but that there was actually over 200 train derailments last year. How many of those are Norfolk Southern? I mean, it's just kind of interesting because when I read that, I was surprised. I was actually just remarking about how newsworthy our Money in the News is because we basically put almost as much time as one of the big 3 on one of the largest disasters out there. So,
doubled the weekly intake on this issue. But, what's also interesting besides the common ownership is that these 2 money managers, BlackRock and Vanguard, are also heavily involved in these ESG funds, which is the new trend in investing. And we've talked about the inclusion in 401ks as part of the latest act by the Biden administration. So, they own the media outlets, they own the rail yard, and they're promoting ESG funds while they're shepherding over the biggest environmental disaster and, since who knows when. And and everyone's like, look the other way, Nothing to see here, folks. Right? Unbelievable.
Environmentally sound.
Yeah. Burn it on site. That's always good.
It's so true. They probably are burning the evidence of something they shouldn't be transporting. I mean, it's probably, they're like, oh, we're burning it because it's the safest thing to do. What are they burning?
It just can't be. I mean, I need a permit to have a fire in my backyard and burning thousands of gallons of who knows what.
Oh, goodness gracious. Someone's probably just said burn it. No permit. Oh, man.
Well, you guys, consumers, are still spending at restaurants despite inflation. Brooke D. Palma from Yahoo Finance, thank you very much, bringing us this information, which is that we're all out there still eating it up. I can see that the consumers are spending at $86.6 billion at restaurants in the month of January, up 24% compared to the same month in 2022. That was some of the latest data from the U.S. Census Bureau. Spending at groceries, beer, wine, liquor was up 5.3%, totaling $78.9 billion last month. So apparently the prices out there are not keeping us from going out and spending. And, the other part of this that was interesting to me was that your Grubhub and, I don't know, wherever you get your delivery meals from, more people are actually starting to show up in the restaurants as well. And so there's been some interesting things with the plays there.
What I thought was kind of most interesting about the article, and I did enjoy a lot of it, but the idea that people spend more at restaurants than they do at the grocery store, just on the face of it, just that simple statement alone, I found kind of mind blowing. I would have thought it would be 2 or 3 to 1 in the other direction, quite honestly. I mean, it just astounds me that people eat out that much.
I got to be honest with you, we eat out a ton. And it's not because we're like dying to eat out. We're traveling between one sporting event and, one, event for one kid over another. And it's like, we need to eat. It's just life is packed with so much stuff. It shouldn't be this busy. And yet, between going here and there, I was like, oh, I'll grab him this. And my wife will go, I'll grab her that. And, we got 2 kids in college. So, it's like, my wife sent in so-and-so a meal pack, or something like that. So it's just always like there's always this out. And when we look at the numbers, I'm like, how is this even possible? Because the food bill's huge. The food bill, there's not a listener now. Nobody's going to disagree with me. The food bill has gone up drastically. Crazy.
I think it's even worse. So the restaurants, maybe that's my personal aversion and why I don't want to go, but we used to be able to go out and it'd be, $100, $120. It's a family of 5. Now, if I get out of there for less than $200, I'm feeling lucky about it. I'm wondering if they screw the bill up somehow.
Yeah, every time I look at the bill, I'm like, how did it get so expensive? I usually, and I tell this to people all the time, eating out's one thing. Like, that's a joy that people have, and I get that. I always tell people, go find a dine-in restaurant, whether it's a pub or something where you can just order your food and you go sit down and you eat. You don't have to pay a tip.
I don't care where if you buy your food from the gas station, they're like tip me 15% on the tab here.
Yeah,
I'm like, what are you talking about? You're a gas station.
I hit no. We talked about that on the show. I hit no now. I'm like, a couple times I got caught, and I'm like, you know what? This is not a tippable thing. I'm doing all the work. Like, you want a tip? You can bring it to me. I think that's sleazy when they ask for that stuff.
Where did I got hit with a tip thing? I think it was at Italy, which is this nice thing in the Prudential Center in Boston. It's like an Italian market, but they have food at all these different places. You walk around, you feel as if you're outside, but you're inside, obviously. But it was literally a walk-through. I didn't interact with anybody. I picked it up, I paid for it, I inserted my own card, and it was like, and there was a suggested tip thing that popped up, and I was like, I haven't even spoken to anybody. Like, I literally did this all myself. But anyway,
one of the big things I learned was that Italian food apparently travels well, and that's one of the challenges I've had with the whole Grubhub thing. Is like, I get the food and I'm like, oh man, this is not as good as I was hoping for. Anybody out there with some helpful tips of where to get your food delivered from other than a pizza?
More than 60 companies tried for a 4-day work week, and results show why 92% are keeping it. This article is by Chris Pandolfo. This is Fox Business. Man, this was a really interesting article. There was 61 British companies with around 2,900 workers enrolled in an average of working 34 hours among 4 days, in which it was from June of last year to December, and they could choose any 4 days they wanted to work.
Right. The only stipulation was everybody had a reduction in hours and kept the same compensation.
And the results of this were actually phenomenal. So at the conclusion of the 6 months, I'm quoting this, at the conclusion of the 6-month trial, 56 of those companies, or 92%, decided to stick with a 4-day work week, and 18 of those companies did so permanently. That's crazy. Now, the article goes on to say, and I think this is really interesting because there's a lot of dynamics around people having, one job or two jobs and trying to fit things in and life in and well-being and so forth. But it says here that 15% of the employees said that no amount of money would induce them to return to a 5-day work schedule.
Yeah.
No amount.
Yeah, people are willing to trade off vacation and raises and just straight compensation in any form you can imagine to maintain that schedule. And this wasn't just something that was good for the employees, by the way. I think it's super important to note that the companies participating saw a revenue increase of 35% on average.
Yeah. 40% of employees almost reported feeling less stressed, and 71% said they had lower levels of burnout.
Yeah, and staff losses were down 57% as well. So, clear message here. People were more productive. The employees liked it. They were likely to stick in their job. And from an employer's perspective, they didn't need to offer them additional benefits to kind of entice them to engage in this.
So there's going to be some more data coming through that I can't wait to see. That was just from England, but there's the Australasian pilot. There's the European, the South African, Brazilian, and then we've got North American results coming in the next few months. Boy, my blood pressure went down just reading this article. I don't know about you, but Ben, I don't know what to tell you, man. Which one of these days are we going to, start checking some boxes here?
Yeah, no, I'm going to try to move mine from a 1-day work week to 4. I've heard that would make it more productive too.
Yeah.
I grew up with my dad working a 4-day work week. And I will say that from the perspective of the kid growing up in that environment, and Dad also took one weekend a month that he was on call. But it was cool. I always knew that my dad had Friday off. And that was, he was at home and he was doing projects. But, he was also working 10-hour days as well during those days that he was on and working hard. But, some of the other things that were pretty cool to see come through was 71% of reduced levels of burnout, and 39% of the employees, felt less stressed. I wonder how many companies, if they go to a shift like this is going to be one of those tools that starts to really attract other talent,
Yeah, I think it would definitely do that. I think people would be very excited about an opportunity to do something like this. But, we were talking before the show, I think it's a great trade-off, too, for those employees out there. You see there's a couple of them going on where they're demanding to maintain this work from home and Zoom in kind of a thing. Well, if that's the trade-off, you got to show up, but you do it 4 days a week as opposed to 5. I think that's a win all around.
Well, folks, were you feeling blue in 22? That's what we're going to be talking about here, is resurrecting your finances, or at least maybe some attitude around the finances. We've got some interesting data to recover from the last year as well. You're listening to Money on Tap. Don't go anywhere. We'll be right back. And you can reach us at 855-226-8551 or info@yourmoneyontap.com.
I'm blue, I've been deed, I've been died, 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 I've been deed, I've been died. I'm blue, I've been deed.
Folks, we have a lot of fun doing this show. Money on Tap. And Ben and I have been financial planners for years and years. And our goal here with you is to bring you into the room, have the conversations that we have. We think these are critical conversations for you, but we understand this is a limited space. And what we'd love to do is to open the doors to you with us at Brayshaw Financial Group so you could experience what it means to have three-dimensional planning in your life. Let's take a look at all sides of your situation, your scenario, and see how we can put together the best plan possible, taking into account your risk. How much can you have in the market? How much do we need to have set aside and doing different things for your life? That's what we do as planners, how we engage with you, and we welcome you to do that with us. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Now, if you have $250,000 that are investable assets today, our planning is free to you. We want you to have the playbook to have a successful experience in retirement. Give us a call, 855-226-8551 or info@yourmoneyontap.com. Ben and I welcome you to Brayshaw Financial for complete wealth management.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about feeling blue in 22. There's been a lot of interesting data that's come across our desks in the last several months, weeks, you name it. Ben mentioned several shows about, the market and some of the titles actually, Ben, that you were coming, that we've used in the past. I feel like, well, folks, we could use a little help on some of those titles. Some of them are a little kitschy and fun for us, but anyways, we love to bring you the news and we love to bring you the information here, and it gives you something to boost your education, boost your planning and the outcomes to become a successful investor here at Money on Tap. And so we are going to be talking about what is some of the costs, right? What are some of the hidden costs inside of 22? And across the board, retirees, this is some of the data that we're looking at is retirees lost 10% of their savings. Across the board, it was roughly around down $21,000, I think was the average. And what's really hidden inside of that for a lot of people is inflation, right? And inside of that market volatility that's happened over 2022 and how people are responding when there's been a 10% drop in the average savings, and how people are responding is not the way that money typically works. Right. And what do we mean by that? When we've seen a dip in the market, we've had them historically. But what we haven't seen is people starting to shut down the way that they're out there spending money. Oh, I guess as I say that, I'm reminded that you're not stopping going out and eating. That hasn't that hasn't slowed down apparently. But you stopped going to the doctor. So, boy, I wonder what eating more out and not going to the doctor outcomes are going to look like for us, folks.
Well, these are all about retirees, Seth, but yeah, that is a good point. It's kind of weird. So 44% of retirees, according to Fox Business, say they struggle to pay for basic living expenses. Now, it's interesting. I can tell you that I have had an increased number of calls from clients saying, hey, I really just need a little bit more income. And we have things set up. We have, all these precautionary measures to, manipulate and manage income and extrapolate more money for people in different ways and how we look at things. And we prepare for that stuff. So it's not completely unforeseen and not completely out of the blue. But some people, I'm kind of like, these people aren't spendthrift people. These are like conservative, kind of everyday, they're eating when the sales are on, down in Florida. I mean, these are people that are really, they're not just throwing money out the window. And I was actually surprised by this one couple that contacted me because he used to work at a bank and he's very, very meticulous financially. And he's like, yeah, things are just a whole heck of a lot more expensive, Ben. I just can't believe how quickly it's grown on us. And so for me, I felt like that one person, he's just really a good litmus test in my head when I said to myself, man, people are really struggling. And, Seth, as you had mentioned, and this is a scary statistic coming from the same Fox Business, 18% of retirees have skipped meals and 24% or a quarter of retirees have skipped medical treatment or appointments to stretch their savings. I mean, these are not small decisions. You're not thinking about like alternating what meals you're eating and taking one less a day because, I mean, I'm hurting beyond eating. I mean, this is well-being.
Well, that's coming to my mind. First is that people are jeopardizing their health over this. I mean, they're finding themselves faced with these kind of drastic decisions, and they're erring on the side of keeping the money in the account, but risking their health to do so. And there's got to be a better way. But what's alarming in all this too is, and these statistics are coming from Fidelity, but they say retirees need an average of 10 times their income by age 67 saved up. And so they're coming up with this number of 541,000, but retirees on average, that's the goal that they should have, but retirees on average actually only have about 170,000. So there's a significant gap going into the problem. And then when you throw inflation on top of it that you mentioned, Seth, it really is making it difficult to have the rubber meet the road here under these kind of conditions for sure.
Yeah, no, I agree. This Fox is quoting that when we've talked about inflation, and so the numbers are all over the place, but this particular article had mentioned that groceries were up 31%, utilities 26%, gasoline 24%, and credit card bills 22%. These are the most common expenses retirees are having trouble affording. Now, I just think it's really interesting that when we're talking about 10% of savings dropping in 2022, markets going down, 10, 20% for people, sometimes 30. A lot of retirees taking way more risks than they should be, or because they feel they need to, I guess, or bad advice. The truth is that if you lost money last year in the market, which a vast majority of people did, if you lost money in the market, it was significantly more poignant because of the inflation that opposed it. I mean, there's many, many years that the market has dropped 10, 15, 20%, right? But the inflationary bubble has never been this great on top of that. And I think that's the scary piece. And I don't know if that's a historical truth or not, but not in our lifetime, at least as we live, But, back in the early 70s, there's massive inflation and so forth. So just pre-me. But the truth is that when you're really breaking it down, having those two forces, it's like two magnets rejecting each other on both ends of the spectrum. You're losing money and everything's costing twice as much.
Yeah, that's the perfect storm of kind of difficult conditions. Particularly for people on a fixed income, that's really got to be a difficult spot to manage through. But really, there are things you can do to kind of assert control over the scenario and to reposition yourself to feel better about tomorrow, even if the last year has been a struggle or you see yourself in that position right now. And one of the first steps that you can take is to understand what it is that you own and make sure that there's a reason around it, right? So take a look at your portfolio, whatever you do have invested, and ask yourself as you're looking through a statement, do you even understand what's here?
I ask this question almost every meeting that we have somebody come into the office, want to interview us and figure out if we're a good fit for them and vice versa. And I'll look at their portfolio and go, so why do you own this? And they'll be like, I have no idea. It's okay. But you should have a reason. It's not that anybody's expected to, but, start taking a little bit of, assertiveness inside, why do I want to own this company? Do I believe that this is a good investment? Do I believe that this company's, are they profitable? Are they paying me to own them? Do they have a yield? Does it fit my goals? Is the investment relevant to what I'm trying to accomplish in life? And do I believe in it? Do I believe that this is a worthwhile company? Get speculation out of your portfolio. It's not healthy and it doesn't work in this market environment whatsoever at all.
No, not for today.
No.
Yeah, any business, right, has to have an inventory and a process of evaluating what is going on or what do they have inside of the business. And the same goes for, your retirement accounts, your financial planning, and there's all sorts of places in our lives that I think are really healthy for us to, sit down and put pen to paper and say, what do I got? What am I working with here? And just have an understanding, have a purpose, have a purpose, especially inside of the inflation, inside of the market pulling back and the headwinds that we're facing right now. Understand that everything needs to have a place and a purpose and a time. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about feeling blue in 22 and putting together a plan for 2023 for you to be successful in your investing. Want to take just a minute to say thank you for joining us by podcast. If you're listening to us via radio, hey, we are also out there in podcast, iTunes, iHeart. I don't know what else, but there's a lot out there that you can find if you want to listen to us on a podcast. And one of the challenges that we love putting out there for you is increasing your literacy, your financial education. Grab one of those podcasts this week, download it, listen to it. Join us here weekly as well on the radio lives, and we just appreciate you joining us in our community out there on Facebook, Instagram, Twitter, LinkedIn, you name it. We're out there, and thanks for being a Money on Tapper with us. So we've got some stuff that we need to get down to, folks, and this is number 2, trust in diversification. Is this something that you've ever heard of? Diversification, right? I think we've talked about it a few times. It comes up in financial planning every once in a while. So how is this going to help you when the market declines, right? It's that idea of all your eggs being in one basket. So many people out there, when the market's on what we'll call a rip, it's going up. Everybody's excited about the market. It's going up. Oh, I've got the QQQ. I've got the this. I've got the that. And everything's, going gangbusters. Well, a lot of people will start to follow, some market trends and start to shift their portfolios and just, 1 or 2 ideas, or even just going into an S&P 500 fund or whatever that is. Having all of your stuff in these ideas, these 1 or 2 ideas, can really, really hurt you, especially the closer you get towards that retirement window. Now, diversification is the idea that not everything is going to be falling simultaneous, right? We have experienced that in these marketplaces where equities, right, the stocks have fallen, simultaneous bonds have fallen, and that's not something that happens traditionally a lot. There was in June there was nowhere to hide. It didn't matter what you were in, right? And so that be diversified was kind of one of those places where people were saying, hey, wait a second. Well, I thought I was diversified here. I've got this 60-40 portfolio, 60% equities, 40% bonds. Why is everything still coming down? Well, historically, the models of diversification will work to your advantage, right, to level out some of the pullbacks as they're happening. And as we speak, we're in a place where we've got rising rates environments, and guess what's happening in some of those bond environments, right? Those flight to safeties are once again showing some promise to really help to buoy or balance out these portfolios. And so, diversification, it works. And you have to take a look at the laws of large numbers as well. Can't just take a look at 1 month, and like I mentioned in June. You have to take a look at historically over time and start to use these towards your advantage.
Yeah, I think for a lot of people, particularly passive investors in a 401k, you just buy a bunch of index funds and kind of ride it out. And in that environment, in a 401k specifically, which is in theory designed to be a kind of long haul investment, that would make sense. But in some of your after tax accounts, if you're investing with a specific time horizon in mind, particularly now under these conditions, just passively holding indexes may not be the play for you. You might want to get a little bit more selective with it, and that's certainly something that we can counsel people. But the third tip up would be to be ready to buy the dip, right? And that's something that we talk about kind of on the heels of a downturn in the market, or for any particular individual stock if you're following a handful of them closely. And all that is really saying to the listeners out there is, be ready to recognize opportunity and get in. It's good to have some cash on hand in your investment account, particularly to get poised for when something, appears to be oversold and looks like a real buying opportunity. Even when the market's down in virtually any circumstance, there's some stock somewhere that's making money that day. Yeah,
I think there's a number of reports. There's more cash on the sidelines than ever in history, and a lot of that has to do with the printed cash by the government. I mean, it's just so much money has been infiltrated into our society this way. But there's more cash on the sidelines than ever in history. So you're not alone for the people who have some cash and trying to figure out where to do that. I mean, we went anywhere from 20 to 30% to cash in our 60-40, 70-30, 80-20 models a couple weeks ago when the market was kind of hitting that peakish range. We started selling a little bit of the tech, or half of our tech holdings actually, for the Qs, and we pretty much got out of most of the S&P, almost entirely for most of the portfolios, depending on this type of portfolio structure. So I was doing a review with a client this morning. I said, we're sitting exactly 30% in your portfolio in cash, and that's where we're at, and we're waiting for the market to kind of get some real stability underneath it, some solid ground, if you want to call it. There's just too much flux, and the Feds looks like they're going to raise rates probably 50 basis points based on the statistical perspective of the people who know in this space. And I would agree that that's probably what we're looking at as of how things look. I think they should have raised the 50 basis points before based on what they're saying. They're getting everything they don't want every time they don't do what they should be doing, if they really think they should do what they do. I'm not a big fan of the Fed these days, and haven't been for a long time. But that has a lot, and I do think there's going to be a real buying opportunity. I think there's enough of hard ground underneath this market, but I think we're still walking on some really soft clay here and slipping around a little bit. And I think when we get down to the bottom of it, we'll know. I mean, we'll know it's going to be painful. It could be very brutal. But I think, we're sitting in cash on a big chunk of assets, and we're looking for an opportunity to deploy, and we feel really good about that. And I'm happy to let everyone else, play in the mud until we get to better ground.
So one of the things I wanted to bring to mind is there's a way to invest called dollar cost averaging, right? And that means that this happens mostly in your 401ks or your those kind of accounts where, you get a paycheck, a little bit gets shifted over to your 401k, it gets invested. And over time, the market's going up and down, and you're kind of averaging out the market as you're doing this. Well, there's also kind of in a bit of a reverse of that is what we're talking about here, where, you've made some on your investments and you go ahead and you take profits, is what we'll call that usually. But it's also, but it works in reverse as well. So, being all in all the time is not necessarily what is advisable, especially when there's such heavy market fluctuation, and we've seen the market pull back like it has, and looking like we've got a bear market rally, which it's pulled back, it's popped up, and that's possibly a good time to go ahead and pull some things aside.
Yeah, and Seth, I mean, I think that's a great point. I'm glad you brought that up. And we've talked about passive and active investing, and here I'm talking about how we've pulled money out of the market. This is active investing. This is us taking a very discerning approach and saying this is what we believe is the right thing for a portion of our assets right now, and that's what we're doing as our kind of overseer and fiduciary responsibilities for our clients. That's when active has to happen. The rest of it's passive. Like, Dan, you were talking about your retirement plan earlier. It's like, there's just some things are passive holdings. We have clients come in, they say, hey, my 401k is getting hit. Let me make sure your allocations look diversified and, and so forth, but continue adding to it because your time horizon's appropriate. If your investments aren't correct, then, we got to change some stuff, and that's how you have to look at it. Number 4 on our kind of like list of things to do here today, get a second opinion. And, that would be someone like us or another, financial company of some sort. Get somebody's opinion who can look at your portfolio and, irrelevant of, what game they might play or trying to win your business, is that another opinion always interesting. Like, right, we go to doctors. Doctors are looking to do the surgery. Like, if you're going to get back surgery, they know you're going to get back surgery. They're trying to sell you on it. That's it's no game. Like, it doesn't matter what you're going to get some work done. That it's all business. It is all revenue. So, don't take it for granted that somebody wants to make a living working with you. Go get a second opinion. I mean, at least if anything, you're going to hear another opinion that will give you some depth and perspective of what else people are thinking out there.
One thing that I found, and this applies to literally anything that can be bought and sold, but, particularly in the financial world, the more conversations you have with people who are offering you advice in whatever genre it is, you kind of build this little bit of a base of knowledge as to what's the company line. What are you going to hear most often? And it just puts you in a position to be aware of what's unique. When you hear something a little bit different, it's memorable. And you think, that kind of gets you the wheels spinning a little bit and saying, well, maybe there's something else going on here that I'm missing, or maybe who I'm working with today, isn't aware of that, or maybe they're limited by license or proprietary product offering, or for whatever reason, they're constrained in the advice they can offer. So just have your ears open for those unique things. It doesn't necessarily mean that's an action step. You don't have to jump into that, but just be aware, because often, there might be some value in just engaging that conversation.
That's a great point. I feel exactly that way when I do research on something, and I look at 5 different vendors and so forth.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Thank you for joining us today. If you're joining via podcast, we appreciate you downloading and subscribing there. All those things are helpful. If you're not joining us via podcast, get out there. iHeartRadio is a great place to join up and listen to us. You can download past episodes and learn a ton. Raise the level of, raise the temperature of the room is what we say, and learn more and get involved and be successful in your investing, folks. We're going to take a quick break. We'll be right back with more Feeling Blue in 22.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms, where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about Still Feeling Blue in 22. Mentioned the podcast earlier. Appreciate the subscriptions and the downloads. All those things help us out there in that world. And if you're new to podcasting, go check out iHeartRadio. Go check out iTunes. Download a couple episodes. Take it on the road with you. I know you're out there, taking care of yourself, getting a walk in, looking for how to improve yourself in 23 and set some new targets. Great way to onboard some information for you is just downloading Money on Tap and getting on board. We are talking about focusing on the long term next. So what is it that a long term allows us to do? Well, in a market decline, right? If you're just really focused on the here and now, and believe me, I'm a big subscriber to, live in the moment, live in the now, right? Because really a lot of things like, shame and regret live in the past. And if you're really focused out on the future, there could be, fear can be a big part of that. But when you're talking inside of a market where you're looking at your portfolio and you're saying, oh my gosh, I'm down 10%, I'm down 20%. Okay, take a breath. That's a good point in time to give a call. Maybe you're out of your depth. Clearly, you're not comfortable where you're at. Okay. So some of the things that we could start to do to try to, take a look at where you're at. What do you have? We've gone through the inventory. We're looking at your assets. How do they serve the purposes? But when we're pulling this all together, we're going to bring it into perspective around that long term. And that's where you've got to be able to have that 30,000 foot view. And most people don't do it on their own, folks. If you're one of the few out there that do, more power to you. All right. There's more people here listening to Money on Tap that are now able to start to do those things on their own because they are here with you listening today and they're learning how to do this. But most of the time, we all need coaches in this environment. You know, we need a coach at the gym to teach us how to lift properly and not get hurt. When you start getting to, I'm going to go get healthy, get to the gym. And guess what? I haven't lifted weights for, 10 years. I don't know what I'm doing out here. Start lifting stuff and throwing it around. Next thing you know, you hurt your back and you're not in the gym and you don't get back. So there's a process to this here. And that's one of the ways that we love to help our clients engage healthy around their finances so that they can start to live in the big picture and take a breath and be able to enjoy the here and now.
Yeah, I think from my perspective on the long-term view it's really simple. It just, if you're able to hold on to that, then the fluctuations day by day don't scare you. They don't knock you off track. They don't create fear. You just accept that that's part of the ride of being in the market and understanding, where you're at today is important, but your eyes are focused 10, 15, 20 years down the road. And you're much more concerned with the outcome at that point than today's reaction to the news on Twitter.
Both of you guys, I 100% agree with. And I just think that the biggest problem for people is they look at their money singularly as it's one asset. And we just don't look at it that way. So when we communicate with people, we're like, well, we have to look at the long term. Like, how long are you going to use this money? But, the money you're going to spend today is not the money you're going to spend 20 years later or 40 years later down the road in retirement. Like there's money today. And if you're just retired, there's money you're going to spend next year. And there's money you're going to spend 5 years from now and 10 years and 20 years. And people invest their money as if it's one block, like it's one asset, and they put it in one thing. And they think that's going to just how they're going to manage it. And the truth is that, every time I've ever, any mentor relationship we've ever had in financial planning, and Dan and I, we audit people, and we don't talk about money that way because it doesn't operate that way. That's not the best way to plan for it. It's not the standard in the industry. But what I do find is people who don't do three-dimensional investing are trying to sell one product or one type of thing. And it's like, oh, put all your money in our fee-based account. We're just going to charge you a fee, and that's all we're going to charge you. And if you make money, we're going to make more money. And that's how you're going to win. And this is our portfolio max for you based on your age. That's a one solution. That's not many solutions. That's one. And then you meet the insurance guy who says, hey, I got this annuity, and it's provides an income. You put all your money in here. You get an income for retirement. And you're all set. That's one solution. And that's the problem. People don't realize you have to time horizon your assets and then figure out what time frame each one of those have. And some of them have long term, some of them have midterm, and some have short term. And I think when you actually put that perspective together, it allows you to really be able to properly invest with some real intentionality around your assets that gives you better opportunity for long-term growth and long-term asset retention, to be honest with you. And the last thing we have is, take advantage where you can. If you have that cash sitting on the sideline and you're buying the dip, or you see a piece of real estate, or, whatever it is that's your opportunity, there's so many different ways. If a Roth conversion is something that's going to work for you, like all of those things are potentially opportunities for you to improve your financial future. So take advantages where, life's, met a gentleman the other day, and he had lost his job because of an injury. He was on workers' comp, and his income was way down. And I said, we were talking about some stuff. He's like, you're in finance. Like, what do you think? I was like, well, if you have an old IRA or something, your income's down, and you're really not affected financially that bad. I said, why don't you just look at doing maybe a Roth conversion or something? That's a great idea. Just take advantage of the little things you can. It really does impact the future.
Yeah, I mean, the things might, appear to be kind of gloomy, but that second set of eyes is a little less emotionally attached, might be able to give you some good guidance there and create a better opportunity for down the road through some simple mechanisms like the Roth conversion, right? So take care of that tax burden and move on from here. So, we've talked a little bit about kind of steps to get prepared, but, what are the things, what are the finite actions that you actually can take, and where do you consider for putting your money going forward? One thing that is an opportunity for today that hasn't been an opportunity in a long time is the fixed annuity world. There are some very attractive rates out there right now for relatively short-term investments. I mean, we're looking at a 2-year rate offering of 5% guaranteed by one of the providers. I mean, I have not seen that in 20 years of working with insurance companies. That's really an incredible opportunity.
the conversation is that you don't have to take the risk. Like if you're burnt out from the market, you got cash sitting on the sidelines, there's always a way to take advantage. Like this is a 2-year fixed 5% rate. There's plenty of time to figure out what's going to happen. I mean, honestly, I don't even know that the S&P is going to be up 5% between now and next year. So,
if you look at a little longer term, we get 5.65 guaranteed for 5 years. I mean, that's the best CD you'll have had in forever. So, real good opportunities there. Something else we do a lot of work with is in the buffered annuity space, or indexed linked annuity space, which is a way to stay connected to the market, participate when the market's good. But there's a lot of strategies built into these kind of products that will protect you from either all or some of a downturn from where we're at today.
Yeah.
You mentioned some great things there, Dan. Inside of that, there's also opportunities in the buffered ETF world as well. It has some top side where you really can cap out at, say, like 20% if the market does that well. That's all you're going to get. But on the downside, it might protect you 10, 15% or something like that. And these are also considered liquid assets, which is one of the places that is really hard to find some of those. It's a very niche kind of a world out there that not a whole lot of people are, engaged in. But these are some of the things that you're just not going to hear, flipping on Money News and taking a listen to Money News. You really got to sit down and spend some time with people that are working in all areas of this and doing the three-dimensional work. And, if it's not us, hey, we'll celebrate it. We will celebrate you working with somebody that has the know-how to get you where you need to go. But doing the work, right? Doing the work. There's no way to get around the fact that you're going to have to engage somewhere, somehow to be successful, right? It just doesn't happen on its own. And we welcome you here at Brayshaw Financial Group and Money on Tap to do this work with us and to learn what it is that is important to you, and to connect you with that next piece so you can take that step forward and be confident in who you are, how you invest, and what those outcomes can look like for you. Build that up. Be successful in your investing.
Yeah, another area that we've talked about repetitively over the last, I don't know, it's probably been on almost every show for the last 6 months, or a year or 2 years, is just, dividend-based investing. I mean, there's just a lot of opportunity in, profitable, big blue chip companies with, some decent yields that could really be a good long-term hold. I mean, depending on, your time horizon and so forth. I mean, if you just want to collect the dividend and you don't really care about, I have clients who have inherited stock, big blue chip ones, that they just collect the dividend. They don't care what the stock's worth tomorrow, the next day. It's, it's been around paying increasing dividends for 25 plus years, and they're happy counting on that. It's not the best way to manage your diversification, as you pointed out earlier, Dan, but but people do that, and I like a diversified portfolio in the dividend mix, especially in this space. The other one we have on our list is bonds. Bonds are a complicated story, but I think if in the same capacity as the dividend portfolio, if you like the yield of a bond and you actually buy the physical bond and just hold it till maturity, you'll get your money back, and that's the guarantee of the bond and claims paying ability of that organization or that government or whatever you're buying. But if it's paying you 5 or 6%, as long as you hold on to it till its maturity, you're going to get your money back.
I think what's in common with these 4 options that we just kind of ran through quickly is that to varying degrees, but in each instance to some degree, there's some predictability in it, right? Yeah. Whereas if you're just riding a straight growth equity portfolio these days, there's zero predictability in that whatsoever.
That's a great point.
As you're nearing retirement, if you need a little bit of that, kind of knowing what's coming around the corner next month or next year to meet your income needs, I would say kind of slim your vision down to some of these 4 opportunities here.
Yeah, to consolidate that too, Dan, you make a point. The bond space and the dividend space, the idea of buying and holding it to some period of maturity, whether it's, how long you think you're going to have it and keep it until you hopefully get your money back and its asset value, or bonds holding it till it ends. That's really where the yield becomes the determining factor if you're happy with that income. With bond funds, which are really dangerous, you have a bond trader who's trading these things in and out. You don't get to decide their maturity, and that's the big problem.
Folks, you are listening to Money on Tap, and that's going to be a wrap for us today. I did hear so much as we went through the show, more around diversification. Not only just asset classes and portfolios, there's activity, there's passive. There's time horizon. There's all these different layers of diversification that, again, that's a big part of what we're talking about here, how you can be successful moving forward. It's been a pleasure, whether you join us here at Brayshaw Financial Group and become a part of our community, or you're just listening. We want to celebrate you and thank you for being here with us. Go download a podcast, take it with you, raise the temperature in the room, folks, and be successful in your investing. Thanks for listening to Money on Tap.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.